Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I have been getting loads of requests questions about what I'm doing in the stock market right now, considering it has come down quite a bit. As you can see, this is my actual portfolio. Right now is £119,436. At one point in the last few weeks or whatever, it has been over £124,000. And as you can see, I've been actually adding quite a bit of money as well. On top of that, basically, some of the companies have not done well at all, just due to what's happening in the overall market. So what I'm going to do now is we're going to talk about a few things. We're going to talk about the market news and why this is happening. We're going to talk about what stock market crashes means to us and so on. And we'll talk about how to value stocks and basically what you're looking for, especially in this sort of environment. And then at the end, I'm going to tell you a couple of stocks basically I'm thinking about. One that I currently bought already. So there's a brand new stock that I bought recently. I've shared it with the community. If you are on the Patreon account, you will be able to see that. If you have not joined us yet, do join us. You can get access to the family portfolio, all the buys and sells. As soon as I make it, I share it with the community. So InshaAllah, you basically join us there. So first thing we're going to talk about is why is the market crashing? What is happening? And a lot of the things that happened in the last few weeks is because there's so much uncertainty about what's happening generally. And one of the things is this orange man has decided to basically start war with every country, with Canada, with Mexico, with the tariff situation that's going on, with the European unions. You've seen what he's done to the president or whatever, the Ukrainian president. He's started all these tariff wars, and what is going to happen in the long run is not going to benefit. Maybe will benefit in the US in the long run, but right now it's not going to benefit them, because if you think about it, all these companies that are now the US companies I'm talking about, buying products from Mexico and from other countries, they will have to pay slightly higher prices because as you know, Canada came out and I think they said also 25% tariffs on their own goods, which means that now the US consumers will have to pay for them. Okay, but he's thinking in the long run, and he thinks basically in the long run he will win this. Let's see what happens. But right now the markets do not like that, because if you know, the world is very much interconnected these days. And because of that, the S&P 500 is down basically year to date about 2%. Dow Jones is actually gone positive just this Friday. The Nasdaq is actually down, and the FTSE 100 is actually doing well. The European basically markets, including the UK, for example, has actually done all right in the last weeks. But when you look at it for 1 year, so from this time last year to right now, as you can see, the S&P 500 is actually healthy, very healthy, almost a 13% up, which is very nice if you think about it. And you probably would have seen a lot of new titles like this and over the last few weeks. So the global stocks are vulnerable in 2025. You might be wondering why. I will explain some of these things in a second for you guys. You've seen this type of headlines, and for that reason, basically people start worrying about. You watch the news, and then all of a sudden people are selling their own stocks because of that. Now I'm just going to highlight some of the reasons, okay, why, for example, why Goldman Sachs basically decided to put this headline out. I'll explain some of the points that they've actually made in this article. And one of the main ones is this part here. Okay, so this guy basically talked about here, the powerful rally in equity prices in recent months leaves equities priced for perfection. That is basically another way of saying things are very expensive right now, because we had a few years of just going up and up and up without some of these companies not having the earnings to back up. The reasons why stocks go up is because they are making profit. Their earnings are going up. So when basically investors expect the earnings of a company to go up, then that's when the stock prices go up for that company, because you rather have 10-15% return from a company than actually companies that are not making any returns on your investment. So for that reason, earnings are powerful things, okay, and because of that, okay, the stocks were going up. Now the issue becomes, but we have a massive issue if, for example, these companies disappoint, okay, on the growth side of things and the earning side of things, that's where it becomes a problem. Hence why you've seen a lot of companies go down 10-15% maybe in the last few weeks, because they reported earnings that were not basically in line with what we basically investors were expecting. And that becomes a huge problem, because that expectation is what is going to kill some of those companies. Some of them is basically unwarranted, because they just overestimate everything. They expected the stocks to go to the moon, but it really doesn't happen. And a lot of the time is because people are expecting Nvidia, for example, to, I don't know, go up 50, I don't know, in the earnings to go up 70-80%, but they might come up and say, you know what, it's only gone up 60%. 60% is absolutely amazing, but that's not what they expected, and for that reason it comes down. So I'm not talking about that. I'm just talking about companies that said, you know what, our earnings will go up about 5-10%, or maybe for 6-7%, and then it went down whatever to 2%. That disappointment, all of a sudden, who would want to own a company that's actually where the earnings are declining? There's this part again. It says much of the strength in equities in recent months has reflected higher growth expectations, particularly in the US, where optimism on basically US deregulation and tax cuts have played a role. This leaves equities vulnerable to any growth disappointment, and this is what I'm talking about, particularly depending on the specific policy measures by basically incoming US administration and relax and basically to tax and tariffs decisions. So if they disappoint at somehow, then of course we're going to have a problem. Then you've got the geopolitical situations with basically China and all of these things. So there's a lot going on in the stock market right now. There's a lot of uncertainty. And one thing that the stock market does not like is uncertainty. It says stocks are more vulnerable to growth disappointments because of the increased concentration of equity market returns. The larger US technology companies, known as the Magnificent Seven, rose by 47% last year versus 10% gain for the medium company in the S&P 500. So the Magnificent Seven were carrying the entire market last year, where the rest of the companies, the medium was about 10%. So there's so much riding on these companies, and they are the ones that have not done well so far. When you look at Nvidia, when you look at, for example, Apple, Microsoft, the Teslas, Amazon or whatever, Google, these are the companies that disappointed a lot recently. So we really need to be careful of what we're investing in and know exactly what is happening around you to be able to survive in this madness. And for you, if you are new to investing, I will advise you to look at, I will put these articles on the basic link, but just go and read about these things. If you are new to this whole thing, there are 3 drivers of stock market growth, okay? And this is basically what the CNBC basically put out recently. And I'm going to share with you guys some of the things, okay? One of the major things they're talking about is earnings growth, which we basically talked about. If a company is expected to grow fast, of course, the earnings are going to the moon. Of course, the stock price will go up with it because there's expectation for the company and so on. So if you look at it here, it says, okay, the boost in earnings should directly result in a basically stock price going up. So say, for example, stock price costed 10 per share, for example, and earnings of $1 per share. If earnings grew by 10% to $1.10 per share, the stock price should grow by 10% to basically about $11. So it helps. The growth of this, basically the earnings or whatever, will help the stock price in the long run. But when the earnings are completely detached from the stock price, meaning the stock price is going up every single week despite the earnings not growing as much, that's where we have a problem. And that's why people say there's a bubble and so on. So you really need to educate yourself about that. And then you've got the multiple expansion. I'm not going to go over this, so you can just pause the video and have a look at it, okay? But sometimes you need to know earnings per, basically price to earnings ratio is important when it comes to these type of things, okay? If a company is trading higher multiples above the average it has been trading over the last few years, then that could be a problem. So what you need to do is actually compare it with the average. So here it says investors generally compare the stock's PE with its historic average. So that's why sometimes when we're talking about individual stocks, we look at the current PE, we compare it with the base last 5 years and so on. We also look at the similar companies to see where this company is, whether they're overvalued, undervalued. If you're paying higher premium for a stock, but the earnings are not basically adding up, then of course you're going to have a problem. And finally, we talk about dividends. The dividends are a form of return to investors, and I really like dividends because I can get return for my money. If it's 2%, if the company is giving me 2-3% basically, then that means I'm at the minimum, that's my starting point. And then whatever happens after that is basically, of course, a price appreciation. If the stock goes basically up for whatever percent that year, plus my 2%, I'm making some sort of a return for my investment. So it is really important to keep an eye on these things and think about the bigger picture. What I'm going to do now is just explain to you one company I've added to the portfolio. I might do a full video of it basically soon, but the company we're talking about today is Novo Nordisk. This company is basically one of the pharmaceutical companies out there, one of the biggest out there right now, 385 billion market cap, is Danish company based in Denmark, and currently trading, of course, in the US. If you look at the year to date, it's about 1% up, but for the 1 year, 35%, 36% down. At one point, this stock was trading $148 per share, and right now it's about $77 per share. It has come down a lot, and a lot of that is basically because of uncertainties in the market, and some of it is because slightly disappointing in some of the deliveries that were expected, or basically there's a demand for some of their products that has not been met. Whatever basically the situation is, for me, it's one of those companies that I really like, and I'll show you exactly the financials. I've already shared it with the community. So currently we've seen 386 basically billion market cap, as a dividend yield of 1.8, sorry. Very, very safe, 99% when it comes to that dividend safety. Now, when it comes to credit rating, okay, as you can see there, very strong. When it comes to the dividend payout ratio, is only 49%. Now, 18%, almost 19% basically growth in recently, which is absolutely amazing. In the last 5 years, about 22%. Normally, what I'm looking for this one here is about 6-7% or higher than that. But 22% is absolutely amazing. They might not continue doing that, but let's see what happens in the next few years. They've increased that dividend for 8 years. They've got $1.62 basically for every share of this company that you own. They also pay semi-annual, so twice a year if you like. And right now, looking at the valuation side of it, it looks like it's actually cheap based on the 5-year dividend average. So the 5-year average basically is 1.4. Right now it's 1.8. So if this number is higher than the 5-year average, then that means it's cheaper. Look at the forward PE. Used to be over 30. Right now we're looking about 22. Now, the healthcare normally has a basically slightly cheaper, slightly lower PE if you like, but this company has been trading quite a lot higher because of the growth expectations and so on. When you look at the earnings payout ratio, it's actually coming down, which is something I like. The free cash flow payout ratio is also coming down, which is great. The earnings per share has grown massively over the last basically 10 years, from $6 or almost $7 to right now $27 per share. Free cash flow per share is also heading the right direction. And when we look at the shares outstanding, they're buying back their own shares. The sales is increasing, or the revenue is increasing from 108 billion to right now 290 billion US dollars. Return on equity of 81%, return on invested capital of 56%, operating margin of 48%, and free cash flow margin of 24%. You don't get many companies basically doing this type of numbers at all. Now going back to Seeking Alpha, if we go to, for example, earnings expectations moving forward, which is something we talked about today, is basically in December of 2025, they're expecting the earnings to grow about 26%, which is absolutely huge. Following year, we're expecting about almost 20%. The following year, about 11%. 13% and so on. And when it comes to the revenue side of it, 26%, 17%, 10%. So even if that happens in the next couple of years, we're talking about market beating returns overall. Now, in terms of valuation, if we just have a look, currently, okay, when we look at the non-GAAP PE for the trailing 12 months, is about, let's say, 27. The sector median is about basically 18, and the 5-year average for this company is 35, which means it's right now cheaper than where it has been trading over the last whatever years. And when we look at the gap, basically the PEG ratio, sorry, and we're looking at for the trailing 12 months, we're looking at 1.2. Now, normally we're looking for gap PEG ratio below 1, but right now that's where it is. But look at the forward, basically is below 1. So that sort of tells me the stock is currently trading slightly cheaper in comparison to where it has been. Okay, a couple of more things, and basically looking at Interactive Brokers, which is basically another platform that I use for the family portfolio. You can see Morningstar valuation is 3 stars right now. Basically, they're expecting the price to be $89 per share. It's about 87 right now, so it's not a lot higher than that. So if we click analyst ratings, for example, I'll show you other companies. Refinitiv ratings, for example, is saying right now 33 basically percent an upside from where we are. Tip rank, for example, is saying it's a moderate buy, and you've got $109 per share. That's about 25% upside from where we are. All of these analysts actually agree the price of this stock should be higher than where it is right now. And when we look at the Morningstar valuation, I've already shown you $89 per share. Just finally to wrap things up, and that's one of the companies I'm buying. There are other companies on my watch list which I will be sharing with the community, but I was just reading this article, why basically what we have learned from 150 years of stock market crash, which is basically published by Morningstar, and there's a lot of amazing information here. If you are new to the stock market, please look at this. I'm going to spend a little bit of time on the lost decade, by the way, because I've been reading about it recently, and it's quite interesting. We can learn a lot from this, because some of you out there are thinking, you know, investing in the stock market, things are going to go up quickly. You might have 10 years of the stock market doing absolutely nothing. And I mean it, genuinely nothing. That's why it's called the lost decade. And then from there, we're starting going up and up and up, and look at where we are now. So that can happen. There is a lot more information on this, why markets crash, but let me just show you this diagram. Okay, since 1870, they've shown that information. They've given it different names to whatever so the Great Depression, World War II, for example. You've got inflationary beat market, whatever. You've got other things that happen over the whatever years, the lost decade, the Black Monday, the Vietnam War, the Ukraine inflation and shortage, the COVID years. All of these things are just noise. Because if you look at this from the 1870 to right now where we are, the stock market has been going up. And that is the bit that you really need to get your head around. You might not, if you invest in the money that is basically you need in the next couple of years, then you shouldn't be doing that. If you do not need that money and you are happy to hold it for the next 5 to 10 years, then you could potentially be making some serious money. There's a lot of information here that talks about the Great Depression, the lost decade, what happened in those 10 years and so on. And look at this, which includes both the dot-com bubble burst and the Great Recession. Though the market began recovering after the dot-com bubble straight away, it basically didn't climb back into the previous level before the crash of 2007 to 2009. It didn't reach that level until 2013. So more than 12 years after the initial crash. I think I'm going to spend a little bit more time and basically talk about this in another maybe video. But this is really important to get your head around, and I hope this is helpful. All I'm trying to do here is just to say to you guys, I'm investing every single day. Okay, and I will show you very quickly, by the way, the company that I just added to the portfolio, and that's the company. I bought about 16 shares, just over £1,000, up about 1% already, which is absolutely fine. But what I'm trying to say to you guys is what I'm doing here is not just a quick buy and sell. If that was the case, I wouldn't have anything in the green. I would have cashed this £16,500. Remember, not long ago, this was about over £24,000. I lost about basically closer to £10,000 in gains over basically a period of 3, 4 weeks, 5 weeks. But that could happen. I could lose all this 16,000 whatever, and I will still be buying more every single day. I want to buy great companies at the discounted prices, because that's what you should be doing. That's what I did with Broadcom when it was actually nobody was talking about the company. I was buying Visa. I was exactly doing the same. S&P Global. You've seen me talk about this company when it was undervalued. And right now I'm up to 33%. I'm not saying I'm genius, because I do have companies that are absolutely in the red. Okay. But at the same time, I have a plan, and I'm going to execute that plan, and I'm going to continue doing what I have been doing over the last whatever years. Why? Because the research shows us, okay, that we are fine as long as you don't panic sell in every day, or you don't look at the prices of your stocks every single day. Anyway, I hope this was helpful. If it was, put it on the comment section. What are you doing during this market crash? Okay, are you buying more? Are you selling it? Have you sold out? What is your plan? Yeah, just let me know what you're doing, inshallah. Have a wonderful day. Assalamu Alaikum.